Across to Ekta now. Dr. Reddy's, there's a bull and a bear case scenario. So Ekta is here to give us both sides of the story. Ekta, over to you.
Well, I'll start with the bull case because the numbers were better than expectations. Revenue was up around 7%. Street was anticipating 2% growth. Margins were better than expectations of around 28.6%. It reported over 29%. And the profit of over 1,370 odd crores was better than expectations of less than 1,300 odd crores. Now, the beat was driven by strong US sales. So US sales were $403 million versus estimates of $355 million and versus a estimate of a Q-on-Q decline, but that didn't come through. Revlimid generic contribution seems to have risen by around $5 to $15 million on a Q-on-Q basis. Europe did well. It was up around 15% year on year. India was subdued, but the company is expecting double-digit growth in the coming quarters, and the company is maintaining its guidance of around 25% margins going forward as well. Now, in terms of the bear case, according to analysts, nearly half of the profits this quarter seems to be from Revlimid generic, while the core profitability was underwhelming according to them. In fact, they expect the core EBITDA margins to probably remain capped at 22 to 24%, and the Bachupalli plant observations, which are around 10 to the FTO3 unit, remain a concern and something that the street would be watching. Also, remember that the stock has run up quite significantly, over 35% in the past 1 year, trading at around 22 times 1 year forward. Now, in terms of brokerages, most of the brokerages I actually saw were negative on the stock. CLSA downgraded the stock to underperform versus buy. Citi sell target price 5290. Antique sell revised their target price to 530 versus 579. Elara reduced target price of 6018. Macquarie has reiterated its outperform with a target price of 6,400. And HSBC is on the fence. They've maintained their hold, but they've raised their target price to 6310 and the target price on the US listed ADR as well.
All right.
Right. Ekta, thanks for that. Let's